Forget everything you have seen in movies. You know that image of your money sitting safely in a dark, cold vault waiting for you. It is a lie. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just signal. The moment you walk out of those sliding glass door after making a deposit, your money is already gone. It's being moved, slide, and lent out to someone else before you even reach your car. Today we're stripping away the professional facade of the banking industry to show you how the gears actually turn. We're talking about the three pillars of the system: intermediation, risk, and the magic trick called fractional reserve. By the end of this video, you realize that the banking system isn't a storage facility, it's a highest stakes engine. And if you don't understand how it works, you are the one paying for the fuel. Quick comment for you: do you actually trust your bank with your life savings? Drop a yes or no down below. I want to see the sentiment today. The matchmaker. Let's start with the basics. Banks are not safe. There are financial intermediators. Think of a bank like a high-end dating app for money. On one side, you have people with surplus cash, the savers. They want safely and a little bit of interest. On the other side, you have people who need capital, the borrower. They want to buy a house, start a business, or buy a car. The banks sit in the middle and say, hey, let me handle this. The catch: the bank doesn't just give you specific $1,000 to your neighbor. They put your money with millions of others. This gives them the scale, the business model. They pay you, the saver, maybe 1 or 2% interest, if you're lucky. Then they turn around and lend that same money to a borrower, a 7, 15, or 25% for the credit card. That gap, the spread, is how they pay for those shiny skyscrapers and corporate bonuses. Does this model feel fair for you? You take the risk of depositing, they get the massive profit margin. Tell me in the comments below, is it fair or unfair? Let's get a debate going. If banks just sat on money, they will go broke. To make money, they must take risks. But here's what they don't tell you: they're playing with your chips. Every time a bank issues a loan, they are betting on the future. They look at credit score, income, and history. But even with all that big data in the world, people still default. Businesses fall, economies crash, the banks run. Since the bank has lent out most of the money, what happens is everyone wants their cash back at the same time. Oh, the money isn't there. It's tied up in a 30 years mortgage or a 5-year car loan. Close your eyes and imagine this. You go to the ATM today. You enter your PIN. You ask for $500 and the screen say insufficient funds in the vault. If that happened to you today, what will be your first move? Would you panic or do you have a plan B? Let me know in the comments below. Fractional reserve, the alchemy. Now that we get the secret sauce, this is the part that sounds illegal, but it's actually the foundation of our global economy: fractional reserve in banking. In most countries, banks are only required to keep a tiny fraction of your deposit in reserve, usually around 10% and sometimes 0% in certain jurisdictions. Alright, let's do the math. You deposit $1,000. The bank keeps $100, the 10% reserve. They lend out $900 to somebody else. That person spends the $900 and the merchant who received its deposit it back into another bank. That second bank keeps $90 and lend out $810. The original $1,000 now created thousands of dollars of new digital money in the system. Most of the money in the world doesn't exist as paper. It's just digital ledger entries based on the promises that someone will pay it back. It is a system built entirely on trust. If the trust goes, the money vanishes. Be honest, did you know banks could create money out of thin air like this? Type "I knew it" or "mind blow" in the comments. This is where most of the people realize the game is rigged. The fragile balance. So why does the government allow this? because this multiplying money is what fuel growth. It's what allows factories to be built and houses to be bought. But it is a balancing act. Liquidity, having enough cash for withdrawal. Profitability, lending as much as possible to make money. If they are too safe, the economy stops. If they are too greedy, the system collapses. It's a razor-thin edge, and history is full of banks that fell off that edge. Today, we're learning the truth. Banks are matchmakers. They are risk takers, and they are money created through fractional reserves. But this leaves us with a massive danger in question. If every private bank is out there creating money and taking risks, who is watching them? Who decide how much interest you pay? And when the system starts to break, like it did in 2008 or 2023, who has the power to print trillions to save it? This answer isn't a person, it's an institution that most people don't understand and even fewer can control. In the next video, we're stripping away the politics and looking at the gods of money, central banks. If you find this valuable, share this video with one friend who still thinks their money is sitting in a vault. Let's wake them up. Don't go away, the rabbit hole goes much deeper. Click the link in the screen to watch the central bank episode. And remember, money, markets, we're trading in the future. See you in the next one.